So for everyone new joining, we're trying something new this week with doing a live stream of the current Eagle Investors Market Recap episode. So, uh, hello and welcome to the seventh episode of Eagle Investors Market Recap. And before I get into today's episode, I'll give a quick a quick recap of what we've seen in the market. So the S&P 500 is currently down 12.95% year to date, and it's down 0.8% for the week. On Friday, we saw large volumes as a result of earnings coming out from key companies, including Amazon and Apple, not meeting investor expectations. And we plan on looking into key economic data coming out this week. In today's episode, we'll be going over a recap of the Fed meeting. We'll be going over what key points from the Berkshire Hathaway shareholder meeting, as well as giving a quick rundown of the current big structure, as well as a crude oil update. We'll be going over the money velocity and how it impacts inflation from here, as well as triple C spreads and upcoming economic data as well.
Nice.
So as we can see here from the chart, the Fed is still pumping money into the economy. We're seeing the balance sheet reach up to almost $6.7 trillion. So the Fed is doing, like we saw it in today's during Wednesday's FOMC meeting. Powell stated that the Fed is focused on measures to maintain economic stability here. And he also mentioned that we could see more aid in the mortgage servicing and municipality side as well. The Fed also Powell also stated that low interest rates are here to stay, and we could see this potentially being something that will stay for the next few years until we see the economy start to rebound from here. Another thing is on the longer term implications. As we saw with the monetary policy here, we saw the Fed going into high yield. We could potentially see them going into equity markets if there's a downturn, as they're trying to stabilize the market through any possible means within their scale. And something that some people have been mentioning is the fact that people are considering the fact that the Fed could go to negative interest rates. I believe that the Fed will do everything in their power to keep rates where they are currently and try to use other measures such as using special purchase vehicles to purchase specific debt or purchase equity if it got to that point. In terms of the Berkshire Hathaway meeting, we saw headlines focusing on how Warren Buffett sold his entire stake in Southwest Airlines, Delta, American Airlines, as well as United. About a month back, we saw reports coming out stating that the Berkshire Hathaway has lower than sold their stake to get lower than 10%. Once they got underneath that 10% threshold, they were able to sell all their shares at the point, so there wouldn't be a dramatic sell-off as a result of Berkshire Hathaway just selling all their entire stake.
So they have cleared out everything?
Yeah, they cleared out everything.
Wow.
In the airline space. So that's something huge, and they noted changes in consumer preferences going from here. All these airplanes are still gonna have to be run, but the fact is, we could see purchases for new airplanes go down as a result of consumer preferences not going to the same level as they were before. Specifically, we saw expectations of consumer preferences in terms of the airlines industry dropping by about 20 to 30%. So we could see a decrease in demand for airline travel from here. And another thing to note is companies are looking to increase their presence online. And to get ahead from here, I believe that a lot of companies are going to start considering working from home as well as improving their current technology infrastructure. Um, a lot of companies before COVID-19 were already implementing measures for work from home system, but now this just accelerated that, so we could see a decreased use for company real estate as well as more potential employees working from home from here.
Wow.
Now, going into the VIX and crude oil. So the VIX is still relatively high, and what this means for trading specifically is that put contracts are still very expensive. So so a lot of investors, they're still uncertain of what's going to happen here. I know, as Julian mentioned, we're seeing a lot of lockdowns being lifted. The question is, are we going to see a second wave of cases, and how bad is it going to be? Another thing that we have to look into is upcoming presidential elections as well. So I believe that the VIX will remain relatively high for the next few months, just due to the uncertainty on both of these fronts. Another thing I wanted to mention with the VIX is uh, the fact that it's going into potentially leaving that backwardation spiral. So over the past couple of months, we saw the big spot price actually be higher than the uh, first month contract. Now we're seeing the spot price be lower. So we could potentially leave this backwardation pattern. And what that would mean is a more stable price for the VIX going from here, even if we saw another downturn. Now, another thing that I wanted to mention was crude oil. So we saw crude oil inventories come out on Wednesday at 8.9 million barrels. So these inventories were were lower than expected, and as a result, I believe that investors started covering their shorts on crude oil contracts, and we saw crude oil increase as a result. So we saw we're seeing the crude oil contract go to 19.7 from earlier in the week being around 15 earlier in the week. So we're seeing a lot of short covering within the futures market. One thing that I want to mention is the fact that we could still see storage fill up within Cushing, Oklahoma. And once that happens, we could see a heavy need for offshore storage. And what that would mean is good news for tankers, especially um, uh, Frontline, for example, and many other tankers. As a result of storage being filled up in Cushing, Oklahoma, they're gonna people who want storage for oil are going to have to pay higher premiums from here. And as a result, we could see these tankers have short-term benefits. A lot of these tankers are meant for short-term trades, and they are very volatile as well. That's something to mention. Now, in terms of the concept of money velocity, so this has become a topic that many economists are talking about recently, especially with the debate of seeing a disinflation in the near short term. And economists are currently arguing whether they can see stagflation in the future, or will see limited inflation in the future as well. So what money velocity is? Money velocity is the measure of the number of times that a dollar is used to purchase goods and services. And as we can see from this graph, uh, the velocity of money has reached its lowest in over 50 years. So what this means is we could potentially see disinflation, and the money that the Fed's putting into the economy is not being spent currently. So what that means is we could see slower economic growth from here. And another thing to mention is we saw China open up again. And even though they opened up, they're not seeing that strong V recovery as a result of the global economy being weak at this current point, and the demand for specific resources are being very low as well. So we could see slower economic growth from here, and with the velocity of money being so low, we could actually see disinflation or even deflation from here. So this is very concerning in terms of economic growth from here, and it could be one of the deflation could be a key thing to look for within the next coming months as well. And this, if there is this disinflation, we could see more money being put into either long-term treasuries or into specific commodities such as gold as well. So in terms of triple C spreads, even though we saw what triple C spreads represent is how the high yield credit market is doing. So how the junk bond market is doing as well. So we saw, as a result of COVID-19, we saw spreads widen significantly, meaning there's more bankruptcy risk within triple C companies. And we saw, as a result of that, we saw the Fed decide to actually use a special purchase vehicle to buy high yield ETFs such as HYG. And we saw that actually tighten spreads a little bit, but then from there, over the past week, we saw spreads start to widen again. So if we see a significant widening here, that means that we could see more bankruptcy risk. And I believe that a lot of this bankruptcy risk is coming from consumer discretionary industries. So looking into specifically retail as well as the leisure industry as well. Now, going into some key industries, key sectors that in their specific performance, we saw energy get hit significantly um, uh, on Friday, and but what we saw was consumer staples performed relatively well. So during Friday's 400-point drop within the Dow, we're seeing consumer staples continue to do well in times of volatility. Now, over the past week, we saw financials do well, and we saw industrials do pretty well as well. And then we saw a continued decline in utilities, and then a decline in healthcare as well. Over the past month, basic materials have done significantly well, and we saw the consumer cyclical sector do very well as well. And then technology has been doing well over the past year as well, um, especially with technology that's able to benefit from COVID-19. So we're seeing some companies that are actually getting increased revenues as a result, and you're seeing infrastructures change technology as well. Now, the last point I wanted to mention is upcoming data that's coming out over the next week. Next week's going to be huge for, as it's the first week of the month, we're going to see a lot of reports coming out. And we're going to see, as a result of that, we could see more volatility, and we could potentially see investors change sentiment from here. So in terms of the economic calendar, pull it up right now. So this week we're like so this week we're gonna see data coming out on obviously initial jobless claims come out every week. We're gonna see that as normal. Another thing we're gonna see is incoming PMI data as well as non-farm payrolls and unemployment. I think one of the key things to look for is unemployment this week. There are reports saying that the unemployment rate can rise from anywhere to 16 to 18%, and this is significant. And we could see on Friday, we could see a dramatic movement in the market depending on how that data comes out. Just with jobless claims alone, there's the expectation that unemployment will reach at least 16% from here. So that's going to be a significant number to look into and could lead into volatility as well.
That number is unbelievable.
It's crazy.
That is unbelievable.
And the thing is, like, this unemployment rate has never been seen a level this high. And like you would have to go super far. I don't think it's ever reached that level, to be honest. And we could probably see the unemployment rate continue to rise if we don't see a lockdown come up shortly. We could see specific small businesses, even if they're able to get a loan, not be able to survive. So we could potentially see that unemployment rate continue to increase. And I believe that a lot of people are still predicting a V recovery, but we won't see that in the near future just because of how many businesses are impacted from here and consumer preferences changing from here as well.
Right.
Is there anything else you wanted to add, Julian?
Well, I think just something I wanted to discuss with you, and I guess pick your brain, just because a lot of people have been reaching out, asking questions as well. You mentioned earlier, you were showing a graph and you were talking about deflation, and you were talking about, obviously during those times, people are going to move into assets such as commodity, well, gold specifically, maybe the 20-year, I believe, treasury you mentioned, right? Uh, Now, uh, and you also mentioned that tech is doing very well. So I've had quite a few people reach out to me and ask me, hey, tech is holding up really strong during this, during so it's kind of like coronavirus resistant, right?
Yep.
So it's holding up pretty strong. But how do you think, from your point of view, having studied the deflation of the graph that you just showed us, how do you think being invested in tech long term would play out if we do hit deflation, and if those numbers continue to be bad? Do you think we will suddenly see like a sharp decline in tech, or how do you think that will play out?
So just looking into tech specifically, if you're looking to trade tech, I think a lot of it has to do with how the market's performing. See that we
Mhm.
did see another downturn in the market. I would believe that tech would follow if it's just a significant enough downturn. So it all depends on how the market is performing, but the overall tech industry is nicely set up as a result of COVID-19. They're gonna survive. I believe that they'll continue to provide their dividends, and a lot of these companies have a lot of cash on hand as well.
Right, right. Another thing I wanted to mention in my personal opinion, I think opening the way the states are going to open is going to really play a very important role in the market. Uh, within the following weeks that are going to be coming up, because uh, it's really going to reflect on, we had Gilead announce the news on Friday, right after
Yes.
market close. So people are a little bit hopeful about possibly something that's going to help with the virus. But then we also have, at the same time, we have some states considering opening in different ways. And and then, as you mentioned, unemployment rates just keep going higher and higher and higher. Now, what happens if the states open and the virus spreads more, right? And
Yep.
then they would have to do some kind of like a like I guess like a shutdown back again, or which would cause the unemployment rates to all of a sudden go really high again, continue going high. I mean, what do you think? Do you think it's a good idea to be long on stocks right now? Like just like a long term investment with all this stuff going on? Because I have a lot of people ask me like, hey, should I be in? Should I diversify my portfolio and be in like different ETFs right now, be long? And I say, in my opinion, there's a lot of different factors going on. With the states opening and all these things, and I want to see what do you think?
So if we see a second wave, I think we'll see specific hotspots, so specific cities that get hit significantly. We could see parts of the country still continue to stay open. But if we
Yeah,
did see a second wave, that could mean that we could see we're most likely going to see a second wave in specific cities. That's just how the virus works.
yeah,
Um, so we could see another downturn in the market because a lot of investors have already priced in the fact that we're going to see the lockdowns lifted over the next couple of weeks. The thing that we'll have to make sure to look into is more trials coming out of other companies as well. The Gilead trial is potentially already priced in as well. So that's
yeah,
something to look into. But I recommend everyone to stay diversified regardless of
for
what
sure. Yeah,
what their view is. This is a super volatile time. I believe that we're not the market has reached a point where it can't move above the S&P 500 can't move above 3,000 until we see significant catalysts allowing it to move further from there. We're still going to see
right.
economic growth not reach the level it did previous to COVID-19. So I believe this is just something that we'll have to continue to deal with, but it's going to be hard to reach the levels of growth that we did see before COVID-19. And I know some people are even saying that to reach the level we did before COVID-19, it would take around 7 to 8 years.
Oh man,
And like
wow.
even before COVID-19 happened, we were seeing worries about slower global growth from here, and we were also seeing more indicators coming out that we could see a potential downturn. And COVID-19 was just a key catalyst to allow the market to fall completely. And we did see a bear market rally over the past month, but now
Right.
we're reaching a critical level where we could see that bear rally potentially turn into a bear market, a further bear market from here.
Interesting. Now, lastly, just a last question for you here. Another one I get asked a lot, and everybody has every trader kind of has a different answer for this. But what do you think would be, or personally for yourself, what is a good hedge to have in the portfolio? For somebody that's basically doing the options and they just want to have a hedge, maybe whether it's in share. Well, it's better actually if it's in shares. What's a good like stock maybe to have as hedge while you're doing these swing trades on the daily or the weekly? Uh, what are your thoughts on that?
Something I wanted to also mention is like hedges themselves say that you did buy TVIX or VXX or some of these other VIX
Hmm.
related ETFs.
Yeah.
They're still relatively high, and the VIX is still relatively high. So even if we did see a downturn, we're not going to
Hmm.
see as much returns as we did previously. And
Sure.
also, we have the Fed as a backstop as well, so they can potentially buy equities if it did get really bad. So I don't think that we could see a super large downturn where we return to the lowest levels that we did see earlier this year. Um, so that's something to just look into. But like potential hedges to own here, um,
Hmm.
is gold. I like gold a lot,
Gold. Okay.
especially as a fundamental play with the amount of money that the Fed's putting into the economy. And then the thing I recommend people to have, especially now, is just having cash on the sidelines. You don't necessarily need to have all your money invested. You could find opportunities in the future as well. The law, personally, I think the risk reward is not worth it to enter here.
Okay. You think staying in cash at this point is definitely a better idea, huh?
I think it's a good idea to have cash just sitting
Okay.
on the sideline, just to be ready for a potential downturn if we do see one.
To take advantage of the opportunity. Okay. Yeah, that makes sense. Great. Yeah. I appreciate that, Vish. It's just a lot of people have been asking that, and I know everybody has kind of their own style. Somebody told me they're interested in holding TLT. Somebody had said TVIX. Somebody had said VXX. So it's I agree with you though. I think cash is probably the best during these times. To stay in mostly with cash, and just because you don't know what the market's going to bring, right? So
Yep.
yeah,
And then I actually got a question. So
sure.
how long do you see, or how long do you see us being in the tanker storage trade? Like 2 to 3 weeks. And then another question is, considering the inflation deflation, which would be a better bet, gold versus long-term treasuries? So just answering the first point of the question is these tanker storage trades are very volatile. So we make sure within our alerts to update it over almost every other day or every day. So these trades, even if they have strong fundamentals, you can see a lot of movement. So I believe these trades are meant for staying within only for a week or two max. And we're trying to swing trade these. In terms of seeing inflation, deflation, which would be a better bet, gold versus long-term treasuries, I think it's a good idea to have both within your portfolio. Um, Regardless, it's always a good idea to have more safer investments, such as long-term treasuries. And then I believe gold will outperform treasuries, but treasuries obviously have less risk than gold.
While you're on gold, what's a good a ticker?
So I
What do you usually
typically
go with?
just buy GOD.
Okay. What do you personally GLD?
Yep.
Or are you okay?
And then I know Ollie trades gold miners as well. So
Okay.
specifically, he looks into the tickers RGLD and FNB.
Gotcha. Gotcha. Okay. Cool. Is there any more questions in there?
No, that's it. All right. Thank you, everyone, for listening to the seventh episode of Eagle Investors Market Recap, and also hearing from Julian on his thoughts on the markets, as well as hearing what he had to say on the Diamond membership plan as well. We're so excited we've been working on this Diamond membership for the past couple of months, and we're able to finally release it to everyone for free for this whole week. And we're excited to announce the sweepstakes as well. That monitor, that $400 monitor, is a great monitor, and anyone who gets that monitor is going to have a great time trading. That's what I can tell you.
Huge.
For
Huge. All right, Vish. Well, thank you. We really appreciate the weekly coverage and really looking forward to it. It seems like there's a lot of big news coming out, and thanks for all the coverage, man. Really looking forward to this week.
No problem. Everyone have a great trading week, and see ya.
All right. Take care, guys.